Well, hello, this is Paul Martin. I'm with Investor Connect, and today we're with Charlie Carr talking about family office investments. Charlie, thank you for joining us.
Oh, I'm glad to be here.
Well, great. Can you tell us a little bit about your experience with family offices and so forth, and also about the recent move in family offices in investing directly into companies rather than going through funds or venture capital, and what trends do you see there?
Well, I lead PricewaterhouseCoopers Family Enterprise Advisory practice, so I'm working with wealthy families, family businesses, and their family offices. And so over the last 14, 15 years of my career, this is what I've done with family offices. So it's been interesting. I know we're nearly a decade now past the 2008, but I still feel like we're seeing a trend that's just played out of 2008. Families at that time, a lot of them were in hedge funds. The family offices, they probably knew that they had these lockup periods, but I don't think they really expected that those hedge fund companies were going to hold them to the lockups that happened. And so when we got into that 2008 crisis, they realized I don't have control over the money. I'm going to get locked up for several years, and I'm not getting the returns that I get out of my private business. And so through the next few years, many of them got conservative, but as times evolved since then, I think that they've said, we don't want to go back to where I don't have control. Even if I have a lockup, even if I can't get it out and I can't get liquid, I want to have some level of control. And I think that evolution has led them to be more direct and to going out there and say, how do I get involved in private equity deals and doing it directly? So it was interesting that 6, 7, 8 years ago, maybe. I mean, I couldn't exactly pinpoint it when family offices would tell me that, and I'm not usually advising them. In fact, I'm not advising them on their investments. But when they'd say that we want to find other family offices to partner with us on deals, it was usually because they wanted to get paid a finder fee up front. They wanted to take the icing off the cake and leave the other family offices, the other portions of the deal. And what I'm really seeing in the last few years is that now they're saying, we want to do this. We're willing to be equal partners. We want to get other families involved in this, but we want to get the benefits of private equity, direct deals. We don't want to pay 2 and 20 fees. We want to get this, ourselves and get the advantage of that.
So how do they structure the fees in that case where they're doing a direct investment? Because someone has to do the due diligence work, and there is a cost to that. And I find that people who lead those things and do the work, want to be compensated for that fairly, of course. But how do they structure them now when you have, say, 3 or 4 single-family offices coming together trying to do a deal?
Well, I've seen some of these where they're actually saying, we're just going to eat that fee ourselves, because you have one family office, in many cases, that's out there trying to source the deals. They're trying to find them. They're sophisticated enough to be able to do that due diligence. And I've seen several scenarios where they said, we're just going to eat it. We're just going to do that on our own. There are other opportunities where they're out there. Other family offices are out there saying, yeah, we're going to try to charge a fee. The problem is that for the other family offices participating, they're less likely to participate when the fees are out there. So that 2 and 20 or whatever version of that they wind up charging, that leaves a bad taste with the family offices and makes them less likely to participate. And I think that's probably why we've seen this evolution to offices just saying, well, we're the ones that have the staff on here that are sophisticated enough to go source and oversee these deals. We'll just eat that.
Well, who's going to follow up on the deal becomes the next question. You have to sit on boards. You have to follow the company. You have to help when they get in trouble, and they always get into trouble. And so how does that work out when you have multiple offices coming together into one investment?
Well, I think that's still to be seen, because I think most of these are. So as soon as I say that, make this statement, you're going to have family offices, and there are some out there that say, we've been doing this for 20 years. I know that's the case, but I think that the bulk of these that I'm talking about are really happening here in the last few years, and I think that's still to be seen how that's going to play out if they go sour.
Is that one reason why single-family offices sometimes come together to create a multi-office group, or do they do that for other reasons?
Multifamily offices were really popular back 15, 20 years ago. They've been really much less popular because of all the Dodd-Frank stuff. When you start doing that investment, now all of a sudden I've got to disclose a lot more the privacy demands of the families. You don't see near as many multifamily offices formed in recent years or post Dodd-Frank as what you saw beforehand. So if they're coming together like that, they're coming together under a more of an RIA, registered investment advisor type format, and really just focused on the investments more so than they are on an MFO type basis.
Wow. Okay. And so it seems like they're getting more active in this space. Is there any particular trends or type of deals that you see are coming up that they go for and things they don't go for?
You know, I don't know if I have a particular insight there. I mean, some of the families that I've seen most recently have been more on the real estate type deals. They've been looking at a lot of commercial real estate properties, things like that. Since I don't directly advise them on this, most of my conversations about their investments are more ancillary. I'm hearing parts of this as I'm talking to them more about whether it's succession planning or setting up an office or diagnostic work for their existing office. I don't get into a lot of that. So, as to whether there's more of a technology focus or things like that, I'm not sure that I can really address that.
My experience is that with standard investments like real estate or something they're more familiar with, they were very comfortable. But when we got into tech investments, healthcare investments, medical device investments, it got to be a lot harder in that case. And assessing the technical risk seemed to be a challenge for a lot of groups. I guess it was going back to what you said, who has the sophistication to really choose these deals and screen them and negotiate them. Because with the tech comes a new element of risk that wasn't there with real estate. Real estate's collateralized. It's going to go great. Tech, you really don't know as much about it.
Yeah, earlier this week, there was an article that I read out there talking about cryptocurrency deals, and the guy that wrote it was making a comment that people are making investment decisions based on what they heard on Twitter or saw on Twitter. Nothing credible or verifiable, and I think that's kind of in line with what you're saying. Some of these are getting very complex. Several different types of family offices that are out there doing venture capital deals, and some of them concern me the way the family offices are. You see one element where we had a family business, we sold it, and then we're out there looking to invest in private equity deals that were, let's say we sold a healthcare business. So now we have a lot of experience. We know healthcare, and they're out there looking for other healthcare type deals. So they're looking within the industry they know. And typically, as long as that generation that was running that business is still around, they can be very successful because of what they know. But then I also see families where you've had a transition in generation, and they've already sold the business, so now you just have the wealth. The next generation is trying to prove themselves that, hey, we're just as good as the generation before us. And this is where I see some of them getting into trouble because they don't have some of the experiences. So they're out there trying to do the private equity deals because they want to get returns comparable to what the earlier generations got off of the family business. And so they're taking risks that they don't really understand and doing deals. And that's a situation where they get into trouble. The third type of one that I see within family offices that I think is a formula for success, and this is where larger, more sophisticated family offices are hiring the right people to go out and do that due diligence. And so they have the staff that know what they're doing, and they're out there looking for it, and they know this is a business. We're going to evaluate each one of these as a business. Our investment is a business, and so we're going to evaluate it that way, and we're going to manage it that way. And all the things you talked about of not just finding the right deals, making sure you negotiate it properly, and then managing and monitoring it and taking a board position if we need to, and potentially in some cases actually having to step in and run it. Those are the family offices that I think are most positioned or best positioned to succeed in this space. So I mean, you kind of look at this when we say family offices, we talk about it like it's one bucket, and I think we all know that I just described three, and it's probably 30 different groups, but those are three that I feel like I see in the private equity space.
Do you see family offices actually setting aside a fund or a set of funds for doing this type of work, or do you see them doing more just off-balance sheet investments, and they just go with the opportunity that comes up? When the VC raises a $100 million fund, they kind of metrics out how much they can put in the first round, the second round, third round, and then they're done, and they've got limits as to how much they can put in. But it makes the decision pretty clear-cut. With the family office, how often do they really follow that model versus they just go with the opportunities that come up?
The more sophisticated ones, the larger, more sophisticated ones that have hired the right staff are doing what you just described. They're setting aside, it's an asset class. They've got an allocation to it that may be $30 million, it may be $100 million. Obviously it depends on the size of the wealth, but but to them, they're very sophisticated, and that's what they're doing. They're participating in some of those deals, or they're choosing to do them direct. But it's a class to them. Some of the ones that are less sophisticated, and in particular, I'll say that scenario where it's more the inherited wealth, and you're now trying to match the other. That's more opportunistic and looking at what just pops up.
And how much do you see them doing real portfolio theory, getting different sectors and balancing between them and so forth versus, again, being opportunistic coming through?
I think it's, I almost want to say it follows the way the market moves as we're, coming out of any kind of crisis, coming out of any kind of a setback, all of a sudden they get more disciplined and do that, and then you get a little bit lazy, if you want to say that, or maybe it's overconfident as you get to the top of the market, and now all of a sudden you're just looking for those opportunities, and you might get out of balance of what your strategy is. But again, it's going to come back to having the right staff and being the right level of discipline. And I've seen where the family office staff, I could probably cite a few examples of. Obviously, I can't say the names, but I could cite a few examples where the family office staff, the investment staff, have pulled the family back where they were wanting to go get more opportunistic, and because they had the right staff with the right level of experience, they were able to pull them back and say that's not a good idea.
Well, I found family offices seemed to fall into two categories. One, they were either strong operators, and it didn't matter what you were selling, they just knew how to expand and grow and make that go nationwide or worldwide. Or two, they were experts in a particular area, finance or consumer products or what have you, and they would either be one of those two categories, and they were looking for opportunities that leverage their experience, and they would do one or the other. But I'm sure there's other angles out there. Someone once told me, if you've seen one family office, you've seen one family office, because they're all very unique and different.
Exactly, and I've worked with some family offices that are very passive investors, and I have some very, very large ones, multi-billion-dollar families that have concluded that their investment advice is hire somebody to do asset allocation and put it all into ETFs, and so that's what they do. They very passive investors don't believe they can do better than that. They're all over the board as to what they're doing.
Where do you think the family offices are most successful at in this kind of investing? What kind of deals or what kind of setups do you think really leverage their structure where it's not a VC fund, it's not a time frame limited deal, and it's a different group coming into it? And in Texas, we have quite a few family offices. People complain there's not enough VCs here, but they often overlook the family office because there's quite a few of those. They're just not labeled as VCs in some cases.
I feel like I see the most success with their investments when they have some proper governance around it. And really what I mean by that is more than one person picking out what they do. When they have a team of people that are picking their investments, that are looking at the deals, and they're leveraging the expertise of a team of people, you're less likely. I guess you can still have a group think. You can still have a group get off and get overly excited by some concept that may not in the end work out and get too invested in it. But the better the governance, that's where I'm seeing the most success.
That makes sense. How do you think they're doing on the follow-up process, going out and helping the company and keeping everybody apprised of how they do? Some companies are not the best at keeping you up to date, and you really have to show up on the doorstep to find out what's going on in many cases. And when you make an investment, that should be part of the game, as opposed to I have information rights, I'm sure everything will come out fine. What's your experience there in the follow-up process?
Well, those best family offices, which is a small portion of the ones that I've seen, but those best ones that really have the staff and they're doing the governance right, they are doing a good job of that. But the vast majority of them are not, and you probably wouldn't know what to do if it's failing. So that's a challenge. Again, to me, it comes back to that governance. Make sure you're setting up the right people to oversee it, the right process to oversee it, disciplining yourself to make sure that when is the time that I should just go ahead and cut our losses on this, or maybe we need to invest time to see if we can help them turn it around.
One of the trends you see with VCs is the move to data analytics, getting different data analytics packages and running the numbers on what's getting funded and what are the comps and what are the growth rates. They're starting to take a much more data-driven approach because there are firms that make that data available, who's investing in what and what's being successful. And, of course, it changes but there's so many deals out there, so many sectors. It's a lot to keep up with. Do you see the family offices going down the same path? Are they also using data analytics? If so, how?
They're trying to, but the technology for what they want to do, I think is still lagging. I've had this year, I think there have been 2 different firms that have reached out to me and kind of shown me where they're trying to develop technology that'll provide this. But getting information on private deals is tough, and then being able to report on it and understand. From what I'm seeing, the technology is still lagging behind what the families want.
Okay. What exactly are they looking for? Of course, we want more accurate information, but is there anything in particular that would be a game changer for an analytics company?
More accurate and more timely would be the 2 out there. Just
the data's lagging. What's really happening is whole data. By the time you get it, it's probably changed again. So that can be a problem, as you said, with the private companies and so forth.
I could talk some about the communication with the family, things like that, but I'm not sure exactly what you're asking there.
Well, most returns are private now. Very few people are going back to the public markets because the returns are so little there. So people have to turn to starting businesses or investing in private businesses because that's where the returns are. There's a lot of different investment pieces people make out there that I've talked to that, some are very interesting and some are very unusual, and some don't have that at all. They're just going to look at good opportunities coming down the road. And so people are taking a lot of different angles into this private investing world because you really have to do that by the time it goes public. All the profits are gone for the most part. It's just pennies at the end after that. Yeah. And so different groups are taking different investment theses into these private sectors. Some are using data, some are using their experience, and I just was looking, fishing for if there's any other angles out there people are using to go after that prize.
I do think that control is one of those pieces, by the way, that they're looking for. They want some level of control. So when it goes public, I guess unless you're going in there and making a massive investment, like some of the big hedge funds might do, where you're getting 10 or 15% of a large public company, you really don't have that kind of control. So when most of these families that we work with, they made their money with a private business, and whether they still have that business or not, they had full control over what was going. They kind of liked that. When they're going to do these investments in other deals, they're looking for a way to have a say in what happens to it, and we want to be part of making it happen. And there's almost a cachet about that. Not only do we make our money in ABC company or whatever, the company with our family name on it, where we made our money, but then we've been able to go leverage that, and we've been able to make huge profits on some of these other companies. I think some of that's how they get known and their reputation, but there's a massive level of control that they want to have.
I've noticed that is a difference that comes from the angel world, and with angels it's come one, come all, the more the merrier and so forth. Whereas the family office, the first question they ask is, who else is in the deal, and do I like that? And I think it goes to your control comments there that if you want to control it, you need to know who's in the deal, who's going to be in the deal, and who can be in the deal, and so forth. And that seems like that's a big issue in this case. You think that's just because of their experience with deals in the past, or just the dynamics of trying to get a long-term profit out of it, or what else drives that?
I think it's both of those things, but unfortunately, in some cases, hopefully it's a small percentage, but in some cases it's hey, we were part of this. It's like being a member of the club kind of thing. Hopefully most of them are not investing based on what they hear over cocktails, but I do think that's part of it. So the control, the opportunity to get the bigger returns, that's clearly part of it. And then I fear that there's a little element of let's be part of the club.
I see. Okay. Well, that was my last question I was going to ask is how do you see them sharing deal flow or syndicating deal flow? With VCs, they have a fairly sophisticated process of if someone invests, they've got a network to go to do follow-on investments. How often do you think family offices have set up similar syndication relationships, if not on a small scale or large scale, or do they do anything like that at all?
I've heard discussion from quite a few of them where it's more informal. I don't think that they've done it contractually that you're obligated to put another $10 million, $5 million into this thing next year or anything like that. But I think it's been informal in that as these deals are successful and we see the benefit of it, then we come up with some other deals, and the families are choosing to participate. Most of what I've seen were voluntary. Each individual deal was voluntary.
So they just shop it around and see who wants to be a part of it, and those who like it jump on board, and those who don't. And I guess some family offices have a good network of other groups and maybe a reputation that they can get syndication follow-on. Even though people want control, they don't always want to invest all the money either. That can get expensive too.
Yeah, in some cases you wind up with two levels of this. So we're talking about multiple single-family offices coming together to do those deals, but we also have some large families within the single-family office with different family members that each control their own different buckets of money. And so there's a piece of those within those deals of just going to the different family members to see who wants to participate in each of these individual things. So they may do, as a family, they may do a single investment, but within that, they've got this partnership accounting set up, and each family member can choose to participate in these different deals themselves. You think about that, there's an extra layer of complexity sometimes on the larger, more complex families.
Interesting. It increases the dynamics that go into making a decision or an investment decision. Is not only does the family, is the family in or not, is who in the family is in or not, and what do we think about that? So it got a lot more layers to it than most groups do, for sure.
And again, that's as you get into a larger family, that can be an issue with your smaller family. Let's say Dad started this business, ran it for 20 years, sold it. He's still running the money. He may be making all the decisions as to how that gets invested. But as you move across the generations and you get into where it's siblings or cousins that are in the wealth, there's often quite a few buckets of trust and things like that they each have the opportunity to choose to direct on their own.
Well, that's great. Those are all the questions I had right now. Were there any other comments you wanted to make that we didn't cover so far?
No, I mean, this is a good start of the discussion. The communication within the family. I guess, so there is one other comment, which would be the communication within the family. As I talked about that, there have been instances that I've seen where one family member was out investing for the family and didn't adequately communicate what they were doing, what they were investing in, the amount of risk, things like that. And that's been a lot of conflict in the family. So when that communication happens properly, then the family can rally behind these investments and you don't have some of the issues. Now, I don't know how much of that actually the target fund or the target company actually feels that conflict that happens, but it can be what keeps future investments from happening. So it's really important within the family that they are communicating what we're investing in, why we're doing it, the amount of risk that it takes, and what we're going to do if the risk turns sour on us. So that level of communication in there is massively important for the family, and I don't know if that's always understood on the outside by the target companies.
Well, that's a key point of any investment, making sure all the stakeholders know what we're getting into and what the risks are, and then how it's going. We see that a lot. People not being kept up to date as to where things really are in the business, and then it's a surprise later, unpleasant in some cases, to the investors when they find out what's really happening. But those are all good points. Well, I appreciate you sharing this information. Look forward to having you come back and tell us more about the dynamics of the family office, as they're a tremendous source of funding for the area, and hope to see more of it in the way going in the future, and seeing what can we do to help them with the process, deal flow, due diligence, all the things you have to do in that direction. But I appreciate you taking time.
Well, thank you. I enjoyed visiting with you.
Thanks so much.